Hey Larry, can you tell the audience what today's video is going to be about? I think he's a little shy. What's up YouTube and welcome back. My name is Greg, and if you're new here, I post videos every single day about the stock market, options trading, and wealth management. If these are topics that you're interested in, make sure that you subscribe and hit the bell so you get a notification whenever I post. Today I want to cover 3 topics. I'm going to tell you what I invested in this week. I'm going to teach you how you can find worthwhile investments for your long-term portfolio. And finally, I'm going to cover a potential bull trap. I'll talk about this later in the video, but essentially what a bull trap is when you see a few days or a few weeks of a green market where people think that the market is going to go up and then it plummets back down to either where it was or even lower. With that all said, guys, let's get into the trade. The first thing that I wanted to cover today is my long-term portfolio and what I bought this week in terms of long-term shares. I bought one share of Microsoft at $145.53. And the reason why I saw value in this company is, of course, they're a gigantic tech company. And tech has sort of been a safe haven during this recession. You see there's a support here around September and October of 2019. Over the last 5 years, it's gone up 250% nearly. So that is a 50% annual return for this investment over the last 5 years. And the other shares that I bought were TQQQ. So TQQQ is a 3 times leverage ETF. So what an ETF is an exchange traded fund. So this one specifically is an index tracking 100% of the largest firms listed on the NASDAQ. And 3 times leverage means that it sees 3 times the volatility that the underlying stock QQQ sees. So if we're looking at the 5-year chart, we can see that it's gone up 135% over the last 5 years, which is an annual return of 27%. The issue is whenever you're investing into 3 times leverage ETFs, you can see if you had bought it at this high here at $114.54, you would be down 60% over the last month, which is crazy. So these obviously see a lot more volatility than regular ETFs. So be careful whenever you're buying into these. I want to show you guys how you can find stocks or ETFs to invest in. So let's go to SPY. So this is SPY. This follows the S&P 500 and it's only $252.09, which is about 10% of the price of the regular S&P 500. These smaller cap ETFs are a lot easier to invest in if you don't have a lot of capital. So let's look at ETFs. The tag here, and you can see you can sort by popularity, you can sort by market cap, you can sort by today's change, we can look at the price, symbol, whatever you want. So generally these popular ETFs will be good investments to make. Obviously look at the chart, see how much they've grown over the last 5 years and assess accordingly what you want to invest in this. Another way that you can find valuable stocks to invest in is by going to thinkorswim by using the scan tool. And if you look here, you can search by market cap. So I suggest a market cap over 10,000 million or $10 billion. And if we scan here, so this will list all of the companies worth over $10 billion. So I would suggest investing in a company that you know of, such as Apple or Aflac. But even though these are large cap companies, they might not be the best investment to make. So if we're going to the charts and we look at Ford, so Ford is a large cap stock, but you see it's not a growth stock. They had a high over here 10 years ago at $18.97, and right now they're worth $5.19. So you would have lost 75% of your money in this long-term investment. So this obviously is not worth it. So let me pull up TQQQ again, and looking at the 10-year chart, you can see that this has gone from a low of $1.44 all the way to $44.34. So that is over 3,000% of return over the last 10 years. So this is Microsoft's 10-year. So it saw a low of $22.73, and right now it's at $149.70 even during this recession. So let's look at the 10-year chart and compare this to Microsoft. You see the previous support for the S&P 500 is around 2017. I told you guys earlier that the previous support for Microsoft was in 2019. So Microsoft has only gone back a few months, whereas the S&P 500 has gone back 3 years. That's why I think of the tech industry as a safe haven during this time. And then we have Boeing up here in the top right, which has seen a 300% return over the last 3 years. The reason I see value in Boeing is because they are the second largest airplane manufacturer in the world. And unless we find another way to get all the way across the world in 8 hours. Airplanes aren't going anywhere. Boeing's not going anywhere. So this is a safe investment, and I think that I got it at a great deal. So I bought this for around $124. We saw a high last year of $40.46, so you can think of this as getting a 75% discount. Finally, the last thing that I wanted to cover in this video is the current recession that we're experiencing. You can see we're down past these 2018 year lows, and if we zoom into the 1 year chart, so these candles represent 1 day. So this is 1, 2, 3, 4 days of a bull run. But I'm thinking that this might be a bull trap and it could get rejected by the simple moving average line here at 266.78. And I'm basing this ideology on past recessions that we've seen. So if we're looking at the 20-year chart, 1 week, if we scroll back to the year 2000 when we had the dot-com bubble, you see we saw the same thing. I'll zoom in for you, and you see it came up. We had a few weeks of green, then it got rejected. You see it consolidated for a little bit, came up, got rejected. And then you see there was a 1, 2, 3, 4 week bull run. And then it got until this exponential moving average line, got rejected again, consolidated, came down, and then came back up, of course, tried to test the exponential moving average line and got rejected twice. So then we saw 1, 2, 3 weeks of a bull run, got rejected some more, and we didn't find support until around here in April of 2003. So I don't think this recession is going to last for many years, as we saw in the 2000 dot-com bubble and the 2008 recession. Let's look at the 2008 recession to give you another frame of reference. So here is the 2008 recession from about the year 2000 to 2011. So we had highs all the way up here at 156, came down, of course, consolidated for a little bit, came up, tested the exponential moving average line, came down, came back up, tested the simple moving average line, and plummeted down. So we saw it consolidate for a little bit, come back down, and then we finally didn't get support until right around here for April 20th, 4/20, 2009. And we see that it started to go up, and eventually we reached the highs that we saw previously. I don't think this recession is going to last as long as we've seen before. I do think we will see more of a W-shaped recovery rather than a V-shaped recovery, as all of the financial experts have been saying. You see it's testing the simple moving average line. I believe that it's going to be rejected, and I think we are going to see a W-shaped recovery. So this is going to come right back down to where it was, and we might see a double bottom. My thinking behind this is because the tensions between President Trump and Dr. Fauci, one of the members of the task force committee for the virus. And I'll show you the news on this. So from this headline here, we see that Dr. Fauci is saying Trump's desire to reopen the country by Easter is an aspirational projection. So he's one of the directors for the NIH, obviously a very influential person in the health industry, and he's basing these ideas based on the data that he's seen. So I think if we don't have the market open by Easter Sunday, or if Trump announces in a couple weeks we won't be opening for Easter Sunday, the market is going to come back down to where we saw it before, if not lower. Future Greg, the editing process right now. I just came across this headline saying Trump is extending the federal social distancing guidelines to April 30th. So my predictions were correct. We won't be opening by Easter. So the markets are not going to be liking this come Monday. And we can take a look at the futures trading to see what's going on, what's to come on Monday. So you see the market has been down 2.19% and it's trading down. It's getting rejected by the simple moving average line. And I believe come Monday, we are going to open down even further than we are right now. Dr. Fauci is estimating that 100 to 200,000 Americans could die from this virus. Another thing that I wanted to mention is the unemployment numbers. We're seeing a 10% unemployment rate. There's no good news coming out about this pandemic. There hasn't been any real solutions to the underlying issue to get back to where we were before in the stock market and go higher. So you might be asking, well, why should I invest now when I can try to buy at the bottom? Well, I've told you guys this before and I'll tell you it again. Trying to time the bottom is like trying to catch a falling knife. What I advocate is dollar cost averaging into the market, buying the dips and buying the highs, rather than putting all of your life savings and your $1,200 stimulus check into the market all at one time, thinking that it's the bottom. So if we go to my Robinhood account, I will show you my account balance. Currently, my account balance is at $4,118.53. So that concludes today's video. Thanks for watching, guys. If you made it all the way to the end of the video, make sure to hit the thumbs up button. I'll see you tomorrow for my full day of options trading. Stay positive, stay green, and I'll catch you in the next video. Bye, guys.